Issue number 2 would be related to calculating terminal value. So as mentioned earlier, we have two parts when we do a DCF analysis. Part number 1 is the part where we calculate present value of explicit cash flow. And number 2 is because we cannot, forecast the company cash flows forever, so we assign a certain year to calculate, and then the years after we do a very simple calculation and drive a terminal value. Usually we recommend you to generally assign a ratio of 3:7 or 7:3, which means that we don't necessarily want it to be skewed to just one part. So it shouldn't be like 8:2 or 9:1. It should be somewhere near the middle. Most preferably, probably maybe 5:5. But 3:7 would be like the maximum extent where it can be, accepted in under normal circumstances. Generally, there are two methods to calculating terminal value. Most of you who have studied financial management or CFA or CPA would be much more used to the perpetuity growth method, where we assign a terminal growth G, a very small number percentage, and we just assume that the company cash flow grows forever in that terminal growth rate G. That is using the perpetuity growth method, which we will be looking deeper just in a few moments. The number 2 method would be called the exit multiple method, and this method assumes that we time travel to 5 years later, and we perform a trading comps valuation or a transaction comps valuation. So we are standing at 2026 point of view, looking at the company and doing a valuation. A valuation based on trading comps or transaction comps. Then we'll have the company value seen from the 2026 point of view. So we have a company value over here, and all we have to do is, because that's the value we're seeing from 2026, all we have to do is to discount it by another 5 years, and we're going to get the present value of the company terminal value. So that's how exit multiple methods are used. In actual practice, both methods are used very often, especially if you go to IB, the investment banking division. The exit multiple method is frequently used. I would say in most academic books, lectures, or exams, the perpetuity growth method has much more to explain. So that's, I guess, much more seen in most cases, but both methods are not that difficult to perform. It's as long as you put in the right assumptions, actually performing it in Microsoft Excel is not that difficult. So I would recommend you that the best practice would be doing both methods, and try to come up with a consensus of you can always compare and see the differences of the results, or you can do both methods and you can assign the terminal growth rate G as a blank, and then do the valuation and calculate the implied terminal growth rate. So if we have the chance, maybe later on we can actually see calculate that in Microsoft Excel. But for now, let's dive a little bit deeper onto the perpetuity growth method. So the key here is to assign a terminal growth rate. In other words, a growth rate that you are assuming that the company free cash flow grows forever. And because it is assuming that the company has entered into a mature growth rate, which usually the company growth rates usually gets slower and slower as they mature, we're usually assigning a very small percentage rate. And by a small percentage rate, we mean around 0% to 5%. Just to be conservative, I did write 5%, but to be honest, I've never seen terminal growth rates go over 3% in a traditional DCF analysis. So usually, I would say I recommend you to use 1%, 2%, or maybe 3% if you're really aggressive. The key logic behind the terminal growth rate of under 3% is usually, number one, the inflation rate. So you're just assuming that the free cash flow grows by the inflation rate. And that's just assuming that if we say free cash flow is price times quantity, we're just saying that price is growing, but quantity growth is 0. So that's showing how conservative your assumptions are on your DCF valuations. And that's how you can, persuade your investors and people who are, looking at your DCF model. So inflation rates are most commonly used. Number 2 would be GDP growth rates. Very similar to inflation rates. The logics are similar. Number 3, some people, or in some cases, we also use long-term industry average growth rates. So, for example, if you're doing a DCF valuation on, let's say, Shake Shack, the hamburger franchise, maybe what we can do is we can get the growth rates of 100-year growth rates of McDonald's, maybe Burger King and KFC, and see how their growth rate trajectory has been the past 100 years. Probably the growth rates would steepen over the years, and maybe we can benchmark that curve and apply it to Shake Shack as well. So that's using the long-term industry average growth rates and analyzing them. So that sometimes does help, other than just simply using inflation rates and GDP growth rates, simply because it requires much more analysis and hard work. If the analyst feels that he or she thinks that the company should perform better than the inflation rate, so if they think that it's a very good company and the growth rate would be has better potential, he or she can assign a terminal growth rate, usually minus or plus 0.5 percentage points, if he thinks so. So I don't recommend this. However, as I told before, valuation is closer to art rather than science. So if you can persuade the people that the target has greater potential, of course you can apply an additional 0.5 percentage point. And when necessary, you can use an average of several logics. And at the end of the day, this terminal growth rate is one of the most important key assumptions, together with weighted average cost of capital. So these two components usually become the key components for sensitivity analysis. So it shows how the results come out when average cost of capital changes and when terminal growth rates changes. So it shows how sensitive your model is depending on weighted average cost of capital and terminal growth. And these two. So when we're using the Gordon growth model to calculate terminal value, we're assuming that cash flow is constantly growing at a terminal growth rate, the growth rate G that we have just discussed before. Free cash flow permanently grows at pace G. However, at the same time, it's going to be discounted more and more by the discount rate, or in this case, the weighted average cost of capital. And when we do that, we get a formula that looks like this. The terminal value on year 10's point of view, this is when we're doing a 10-year DCF, is free cash flow on year 11 divided by the weighted average cost of capital minus the terminal growth rate, which can be, again, once more, recalculated by year 10's free cash flow times 1 plus the growth rate divided by the weighted average cost of capital minus G. This was recalculated especially because when you're doing a 10-year DCF, we only have the free cash flow for year 10. We don't have a free cash flow for year 11. So we're doing usually using the latter formula instead of the former. This formula looks complex, so unless you're actually preparing for a technical interview, I usually recommend my students to look the formula up in Google and always double check the formulas. When I was an analyst back in Goldman Sachs, I once made a mistake of switching I think the denominator, and it led to a very painful mistake. So I always recommend you to look up, because you don't use this on a daily basis. You don't perform a DCF, you don't calculate a terminal value on a daily basis. So it's very often forgotten. So I always recommend you to double check the formula from Google or whatever source you have, and then perform it on Microsoft Excel. The formula does look complex, but the gist is that the higher the weighted average cost of capital, the lower the terminal value. So the lower the enterprise value is going to be. On the other hand, the higher the growth rate, of course, the higher the terminal value and the higher the enterprise value. So that is the key thing to keep in mind here. One more thing to note is that if you use this formula to calculate terminal value, this is terminal value seen from year 10's point of view. So we're doing a DCF from year 0's point of view. So what we have to do here is we have to discount the year 10 terminal value by 10 years just once more. And we're going to show you how it's going to be done in our Excel session.